Thanks for tuning in to this week's Signature FD investment audiocast that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So last week we did do a longer form version of this audiocast with some thoughts on potential policy impacts for investors in the upcoming election. So for this week, what we're going to try to do is keep it a little more succinct. So looking at market trends last week, large cap US stocks rallied somewhat, but small cap stocks and developed international stocks, those lagged. As tensions in Israel and Iran ramp up and China issued stimulus, those things kind of came together to create some upside in commodities last week, and particularly oil and gas on the week. So it makes sense that the market was somewhat risk off despite the small gain that we saw in the large cap US stock space. Now, certainly the market's somewhat stretched from a trend perspective. So it isn't really going out on a limb to say that one might expect some form of consolidation in the weeks ahead, especially leading up to the election. But our friends at Ned Davis Research reminded us that strength often begets strength. The market rallied 5 months in a row. And in fact, they show that returns have tended to be stronger than average over the next month and even up to a year later after the market has rallied 5 straight months. So the trend evidence that we watch is still broadly bullish. Now, market trends have been supported by a resilient economy, especially on the services side. ISM released their Services Purchasing Managers Index last week, and it showed robust expansion in that sector with a jump in new orders. Also, last week, we got a deluge of labor market data. Now, on net, it's very tough to spin that batch of jobs data as negative. There were more job openings in August, and layoffs were very low. And then in September, both payroll processor ADP and the official government BLS jobs report blew away economists' estimates. Job creation was even revised higher for the prior 2 months. Average hourly earnings were up 4%, and the unemployment rate ticked down. Now, 4% wage gains, that's quite solid and supportive of further consumption. So for now, we continue to believe that there's a positive feedback loop between strong corporate profits, worker retention, rising real wages, and therefore consumer spending. Now, as for what we're watching in this week ahead, we're going to get inflation prints later on in the week. Now, consensus expects for those to be relatively mild and supportive of another Fed rate cut in November. As the economy remains on solid footing, policy adjustments are likely to be smaller going forward. And historically, that would be a good thing. Slow Fed easing cycles have tended to be a bullish condition for stocks. So tune in next week to hear our take on that inflation data. And as always, thanks for listening and have a great week ahead.